Hello, in this video I'll be going through long-term contract accounting. Let's just briefly talk about revenue recognition. Companies recognize revenue when goods or services are transferred to customers for the amount that they expect to be entitled to receive in exchange for those goods or services. There are 5 steps that are used to apply that principle. Number 1 is identify the contract, identify the performance obligation or obligations, determine the transaction price and allocate it, and we recognize the revenue when each performance obligation is satisfied, meaning complete. Many times there's a long-term contract involved, such as if a company is building an entire building or an airplane or a portion of a highway. And so sometimes the revenue has to be recognized before the final delivery. So there's two steps out of that 5-step principle that we just talked about that can cause an issue with long-term contracts. Step 2 says identify the performance obligation. Well, when you're building a building, a high-rise building or a hotel, you can't separately identify each good and services, right? Because they need all to be included in order to have the building be complete, or your hotel. You're not going to say, oh, well, as each door is its own distinct, good and service that we're going to apply performance obligation criteria to. It's the entire building is one single performance obligation. So the other issue with long-term contracts is recognizing revenue as each performance obligation is satisfied. So when we're talking about long-term contracts, there are 2 different ways to recognize revenue. One of them is you recognize the revenue over time according to the progress toward completion. And there's certain criteria that needs to be met in order to qualify for this. This is called the percentage of completion method. And most contracts qualify for that. The second way is recognizing the revenue upon contract completion, which is probably not preferable to most companies. Because think of if a company is building a whole hotel, it might take them a few years to complete that construction. And so to recognize the revenue only when it's completed is kind of misleading to the financial statement user, because they see all these costs being incurred but no revenue being generated, where in fact the project is in process, they just don't see it on the financial statements. So usually the percentage of completion will give the financial statement user a better overview of what has actually happened with the company. Let's go through an example. At the beginning of 20X1, the Harding Construction Company received a contract to build a small office building for $500,000. Harding will construct the building according to specifications provided by the buyer, and the project is estimated to take 3 years to complete. According to the contract, Harding will bill the buyer in installments over the construction period according to a pre-arranged schedule. So this is going to be a percentage of completion example. Before I start on this example, I'm going to split this video into 3 different videos. First, this video is going to be focused on the balance sheet side of the accounting for the long-term contracts, and then I'm going to have a different video for the income statement side, and then I'm going to have a third video demonstrating what happens when a contract has a loss, an overall loss. So this example right here is when the contract has a profit, overall profit. So, and it's the same numbers as if you're using the textbooks. This is the same example, except I've cut out 1 0. So instead of the contract price being $5 million, here the contract price is $500,000. So I've just kind of laid it out differently here in this video versus the way it is in the textbook, and you can decide for yourself which one is easier for you to understand. But we have a contract price. That's what we're given in the problem. We're also given these other facts, and I want to go through them one by one. The first one is, so this is, imagine a construction project where there's costs incurred, right? And at the same time, you're also billing your customer for as you're working on the construction, and the customer is going to be paying you for those bills. Okay, so we know that the contract price is $500,000. Then we're giving the costs incurred during the year for each of the 3 years, X1, X2, and X3. So I'm going to point this out because we're going to need it for later, but the costs incurred during the year, this is for each year. So at some point we'll need the cumulative costs, so we'll have to add up those costs each year. And then we're giving the estimated cost to complete. So this is how much the company thinks that are the total estimated costs that they think will be needed will incur in order to complete this project. We have billings to customers in the current year. So this is what we billed our customers, and our customers have paid us this much. Okay. So on the balance sheet, whether you use the percentage of completion or the completed contract method, the balance sheet is not any different. But what we are going to do is we're going to introduce some new accounts. And those accounts are, number one is a construction in process account, and we abbreviate it as CIP. This is an asset account, and it's an inventory account. And this is where we're going to record our costs that we incur every year for this project. So we're told in year 20X1, right? We're going to look at this right here. Let's just highlight it. I don't know if this is a highlighter. Yeah, there we go. 20X1 that we incurred $150,000. So we're going to debit the construction in process for $150,000. Our credit is going to be remember, these are the costs that we incur. So this is us buying the building materials, buying toilets, buying doors, all the things that go into constructing a building. And so whether we pay cash for it, if we pay cash for that, we would credit cash. If we're getting billed for that, right, we're going to credit accounts payable. So that's why this says cash, materials, payables. It's just which method the company used to actually pay for that, those costs. I want to go through, now we're going to record the billing of the contract, of a portion of the contract. So we're told on row 7 here, the billings to customer in the current year, and the current year was $120,000, right? So, so normally we would be able to debit, when we have a sale, right, we would debit accounts receivable, let's call this $120,000, and credit revenue on the income statement, $120,000. But at the same time, we would also be removing the inventory from our books. We would debit cost of goods sold for some dollar amount and credit inventory for that same dollar amount. So when we book a receivable, we also at the same time remove the inventory off of our books. Now let's go back to this first journal entry, this construction process. And remember, I said this isn't actually an inventory account. So if I just record sales revenue when I do the billing, then I am keeping this it's kind of like inventory, this inventory account on our books. And I can't do that. So I'm going to credit what's called billings on construction contract. And also I'm not recognizing revenue right now because this is a long-term contract, and so we fall under different accounting rules, and the revenue is going to be recognized in a different manner. So this part of the equation will be dealt with later. But this billings on construction contract is a contra asset account to the construction in process account. So if you recall, a contra asset account, it has a different normal balance than the normal asset account. Its normal balance is a credit. But when we record it on the balance sheet, we're going to look at our construction and process account less our billings on construction contract, and we're going to report the net of the two as an asset or liability depending on the balance in those two accounts. So when I bill my customer, I'm going to debit accounts receivable and I'm going to credit billings on construction contract. Next, we've received cash, so we are actually going to, we received $100,000, so we're going to debit cash for $100,000 and credit the accounts receivable for the $100,000, just like we normally would. Let's go to our T accounts. So let me just scroll down right here. We're going to use these T accounts throughout these videos. I'm just going to go right here. So we just did our first year, and we have our construction in process T account and our billings on construction contract T account. And so far what we've done for 20X1 is we've incurred construction costs of $150,000 and had billings for $120,000. So as of right now, without recognizing any revenue, which will come in the second video for this series, our construction process is $150,000 and the billings total is $120,000. And when we report that on the balance sheet, we're going to net those two items together. So for the balance sheet presentation, we're going to have a current asset, right? And we're going to have our accounts receivable. And remember, our accounts receivable is the ending balance at the end of the year. So we had a debit of $120,000 and a credit for $100,000. So our net is a net debit or balance of $20,000. So we're going to report our accounts receivable of $20,000, and we're going to have what's called CIP, which is the construction in process, in excess of billings for $30,000, and that is the $150,000 less the $120,000 at the end of year one. Now let's go up to and do year two. In year two, we're told that the costs incurred during the year were $100,000. So we're going to debit the construction process for $100,000 and credit, let's just call it cash for $100,000. Okay, let me just go to this. And then the accounts receivable, we're told the billings in year two was $200,000. So we're going to debit our accounts receivable and credit our billings on construction contract. And we're told that the cash that we've received is $140,000. So we're going to debit $140,000 cash and credit accounts receivable for $140,000. And then in year three, we're going to do the exact same entries for the year three information that we have provided. So let's just go to year two balance sheet. And year two, we incurred costs for $100,000. Let's go to our T accounts right here, right? And so we're going to debit our construction and process for $100,000, and now our balance in our construction and process account is $250,000. It's the $150 from year one plus the $100 from year two. Remember, this is a balance sheet account, and it's like acts like an inventory account for us. On the flip side, for the billings on construction contract, we started our 12/31 X1 balance was $120,000. We billed another $200,000, so our ending billings on construction contract is $320,000. Let's go to our balance sheet for year two. Our accounts receivable now is $80,000. If we were to draw a T account for the accounts receivable, we would see that, but our $80,000 is going to, because it's a balance sheet account, it's going to be made up of the billings to customers from year one and year two, less the cash receipts from the customers from year one and year two, and that nets to $80,000. Now notice when we look at our T accounts for our construction process and billings on construction account, billings on construction contract, our CIP is $250, but our billings is $320. This gives us a net credit balance, right? When I take the 250 minus the 320, it's a net credit balance. So now it's more of a liability. So we're going to record in the current liability section an account, and it's going to be called billings in excess of construction in process for $70,000. So this is the balance sheet accounting for a long-term contract where we get installment payments. And it is the same, again, this is the same for whether you're using the percentage of completion method or the completed contract method. Where it differs is on the income statement, which will be in the next video.